Hello, you guys. Hey, this is actually my third try to make this video. I've made it a couple times and it won't. These videos aren't refusing to process. Crazy. I let this last one go for like 12 hours. Never processed. I don't know what's going on, but they changed everything around YouTube again with the comments and all that. Again, improvements, which it was better 12 months ago, but hey, Google's improving it. But anyway, I wanted to read this. I ran across this article, wanted to pass it on, read through some of it here. Um, this is about how, everything that's going on today and now people are like resigned to, well, I guess everything's okay. There's people all over the markets now that just tell you, oh, if anything ever goes down, you just buy it. You just buy the dip, because it's going up because Bernankes just going to keep going. But let's just see what they're actually doing. And this is from Phoenix Capital Research, called "The First Stage of Inflation Has Already Hit." Next up is the currency collapse. So they're saying that inflation's already um, in a whole lot of things, which it is. Obviously, here's this first little chart here with the U.S. dollar since January 1st of 2010. It's up 2%, but you can see all this other stuff, gold, silver, wheat, and everything's up 20 to 75% this year. So the first part of this article goes, one of the biggest misconceptions about inflation is that the U.S. dollar needs to collapse in order for inflation to occur. While the currency collapse often accompanies periods of heightened inflation, it's not necessarily true. As you can see, we've already had an inflationary spike in commodity prices in 2010, despite the dollar rallying 2% during that time. Indeed, the inflation in the U.S. is experiencing today is rather unusual, as it has been accompanied by deflation at the same time. So here comes around this whole thing again with biflation or whatever, which actually, people are trying to call whether, well, what are we going to get, inflation or deflation? That's what Bernankes taught. Well, we got inflation in check. Well, check all commodities, Bernanke. A lot of this stuff, wheat, corn, up 30 to 40%. But of course, they in the official inflation numbers, they don't count food or energy costs. So that's real convenient for them. But anyway, as I write this, the U.S. is experiencing deflation in housing prices and incomes, combined with inflation in the cost of living, energy, food, commodity prices. So thus we see deflation and inflation occurring simultaneously. It's not surprising, as the Fed's primary moves since the financial crisis hit are buying debt. That's Bernanke in there pumping up the buying all the bonds and stuff, which is backfiring on him now, by the way, with the yields going up. Just in the last month, so far since QE2 started, of course, they're not going to talk about this on the news, but he's already lost $47 billion buying all these treasuries. So the Fed's moves so far are buying debt and pumping money into the banks. So the banks are sitting on tons and tons of cash. So no wonder when they come out with these BS earning reports, oh, well, we had a pretty good quarter. Oh, gee, well, stuff my vaults full of billions and millions of dollars. I'll tell you, it's okay too. Tell you, I'm having a good time too. Whatever. Okay, so the first move, buying debt, was designed to attempt to stop debt deflation. In other words, all this stuff that's sitting on the bank's balance sheets. Well, what's mostly there? All this real estate and mortgages, right? So that's their move. They're buying debt. They're trying to stop the bank's balance sheets from deflating. And it's about at the point where it's not working. Anyway, as I've noted in other articles, the Fed is failing miserably at this. Bonds are tanking, says in the article. The purpose of the Fed's secondary move, that's pumping money into the banks, was to shore up the bank's balance sheets with hundreds of trillions of derivatives Remember, I mean, these guys have what? I mean, up to a quadrillion, 1,000 trillion in all this debt. That's what they're desperate on trying to sweep under the rug here. That's not working. With hundreds of trillions in derivative exposure and off-balance sheet toxic debt, most U.S. banks are insolvent right now as we speak. As everybody's saying that, oh, the economy's recovered. Is that true at all? No, it's not true at all. All these banks are insolvent. You know, anybody who's saying that everything's recovered, just reply to them or Bernankes or whoever. Okay, we'll go ahead and raise that 0% interest rate up to about 3, a measly 3, and quit all the quantitative easing nonsense. Go ahead and see what you get. Okay, so indeed the monetary base has more than doubled since the financial crisis began. Another chart here you can look at. What you're looking at is the Fed producing 1 trillion of money out of thin air. The reason we haven't seen inflation in the form of a US dollar collapse yet is because Europe is imploding, pushes the US dollar a little bit higher. Just like two winos down an alley or something, they're staggering down the alley holding each other up. The banks are sitting on this money, not lending, so it's not getting into the economy. Regarding, I'll pull this out a little bit more. Regarding the chart below, regarding number 2, the chart below explains everything. Okay, that's basically a line from 0 up till 2000, the mid 2008. Then that goes up from 0 to now we're looking at, you know, $1.2 trillion that are just sitting on bank balance sheets. Okay, the above chart depicts the amount of money U.S. banks are sitting on in excess of what the Fed requires them to hold. All banks must hold a certain amount of cash and reserves. As you can see, up until early 2010, the U.S. commercial banks were sitting on nearly 1.2 trillion in excess reserves. So in plain terms, the Fed's money pumping, at least the money we know of, which is a whole nother story. Who knows? Just a month ago or so, there was that story with the $9 trillion that, you know, oh yeah, well, we had an extra $9 trillion that went to foreign banks and all this. So this is why the US dollar has yet to truly collapse. The Fed's money pumps have yet to get into the economy. Instead, the Feds are just sitting on the cash. It's not actually even cash, it's just extra added decimal points and zeros. However, this doesn't account for the Fed money pumps that are non-public. It's no secret that the Fed has been pumping hundreds of billions of dollars to financial firms without the public's consent. Well, they never had the public's consent to do any of this. Even the first bank bailouts, they had 85% of the people were dead against it, but they did it anyway. Okay, according to Neil Barofsky, the Special Inspector General of the TARP program, the Wall Street bailout could end up costing the U.S. up to $23 trillion before it's over. Good luck on, we got the economy recovered now. Okay, now you got to go in and pay $43 trillion. Who's going to pay that back? I'm not. Obviously, a heck of a lot of money has been flowing into Wall Street that we don't know about. And Wall Street has done what it does best, pour this money into the financial markets, which has driven stocks, commodities, and risk assets in general through the roof. To the point today where, I mean, you got good people on Wall Street, otherwise smart people saying, oh, yeah, you just got to buy the dips. Everything's good now. This is just going to go on forever. Well, is it? It's a freight train headed, you know, headed off of a cliff, but they say there's no problem there. It'll just keep on going. This is why stocks and commodities have displayed such an unusually high correlation since the Fed started its QE1 program in March 2009. It's all about Wall Street putting the Fed, some of the Fed's money pumps into the markets. They're just buying stocks. They're pumping up stocks. Thus today in the U.S. we have debt and housing deflation combined with cost of living and asset price inflation. However, I want to stress that the inflation we're seeing today is just a taste of what's to come in the next year. Indeed, our current inflation is all about loose money flowing into commodities, pushing up the cost of living. This is the financial speculation form of inflation, and it's just a precursor to the next far more serious stage of inflation, the currency collapse. And who knows, who really knows what's going to cause that? An event could cause that, to where the dollar just unhinges, and nobody wants to touch it. All of a sudden, you'll have these Europe riots going on in the U.S., and anything could set this off. Yes, deflationary forces remain a risk in the near term. We never, that's an important point. I mean, all this stuff they've supposedly fixed so far, since 2008. Well, they haven't corrected anything. They haven't corrected any of this stuff, and most of it was a bunch of criminality. Has anybody even been charged or arrested yet, besides Madoff, which is a whole different story? That was just one little fun thing, but nobody from these banks has even had to pay any price for it. So they haven't corrected anything. But ultimately, inflation is the end game, and when it hits in the form of a currency collapse, it will be fast and violent. Okay. So, now, the thing is with all this, the next thing we're going to see when this stuff does, the next damn market crash we have, the next crisis we have, that one's going to be fast, because all this stuff from the markets, you're not going to see the Dow just go down 20 points or something a day and slowly go down. One day it'll just all be shut down, or who knows what they're going to do. Everything will just be non-accessible. They'll probably blame it on, computer hacking. Who knows what they're going to do, but yeah, when the next serious thing hits, who knows when it'll be, Monday or months from now, who knows, but the next one will be a real violent occurrence. Anyway, I'm going to try and upload this again here. This one ran way too long. Sorry about that. Well, anyway, have a good day. We will talk to you later. Bye.